Overview of accounting principles. Cost principle, objectivity principle, accrual base of accounting, matching principle, realization principle, double entry principle, entity principle, and going concern principle.
The cost principle states that when an asset is purchased, it must be recorded at the price that it was purchased and not the market value. For example, if a computer is acquired after paying 10,000 Rand cash, the computer will be recorded at 10,000 Rand. In the general journal, the computer was debited by 10,000 Rand. The objectivity principle states that when an asset is purchased, it must be recorded at the cost price and not the current market value. This is because you will have factual evidence such as a receipt stating how much the asset was purchased for. For example, if a business purchases a microwave for 5,000 Rand, but the current market value of the microwave is 7,500, the asset must be recorded at 5,000 Rand, which the owner paid. The accrual basis of accounting states that a business should record a transaction once it arises and once it accrues. This means that the business should record an expense or an income even while it is pending to be paid or received. The matching principle states that expenses should be recorded when incurred for the purpose of producing revenue. Matching principle is a concept of offsetting expenses against revenue for the basis of cause and effect.
The realization principle is based on recording income today when the business earns the sale. It is relevant when the business receives the money. For example, if a business sells a bicycle today for 3,000 Rand but agreed with the customer to pay at the end of the month, the business will record the sale by debiting accounts receivable and crediting sales. The double entry principle. With every debit, there is a contra credit entry. For example, the owner bought stationery from Max Traders for 3,400 Rand cash. Bank will be credited with stationery of 3,400 and stationery will be debited with bank of 3,400. Entity principle states that the fare of the business must always be kept separate from the fares of the owner. For example, if an owner bought a new computer from his personal bank account, one would record it as capital contribution. Going concern principle. Statement of financial position of the business is prepared on the assumption that the business will be in continuation for the next 5 years. In other words, will be in continuation for the foreseeable future. What is the purpose of accounting principles? Accounting principles dictate how financial statements are to be prepared. Public companies, non-profit organizations, and government entities are all required to prepare financial statements according to GAAP, generally accepted accounting practices. Presentation of assets, liabilities, revenue, and expenses on the financial statement. Reports and measures profit and losses on financial statements. Disclosures what information must be presented on financial statements.
Enterprises make use of different accounting processes which use debit and credit entries in the books of business. So the question arising is, how does one know which account should be debited and which account should be credited? So we use the solutions of the data and CLIC methods. So for the debt, it would be your debits, your expenses, your assets, and your drawings. So all of these will increase on your debit side. So say for example, an enterprise paid a petrol expense which was 60 Rand. So you paid it in cash, therefore you drew up a bank T account and a petrol expense T account. For your bank is an asset, and therefore your debit side would increase and your credit side would decrease. So you paid it, that therefore your bank is decreasing, then you'll write petrol expense of 60 Rand. And then for your petrol expense, again it's an expense, so it falls under the debt, and therefore your debit increases and your credit decreases, and you paid with pure cash 60 Rand. And there we have it.
Every enterprise makes use of the accounting process whereby you have to debit and credit certain entries in the books of the business. But how do we actually know which accounts to debit and which accounts to credit? This is why we use the dead CLIC concept. In this video, I'll be explaining the CLIC concept. So basically, CLIC stands for C is credit, L is liabilities, I is income, and the last C is capital. This basically helps us to understand that any accounts falling under liabilities, income, and capital has to increase on the credit side of the business's books. For example, a business takes out a loan at the bank to the amount of 50,000 Rand. How do we know what account to debit and what account to credit? So firstly, we have to think. A loan is a liability, and therefore immediately CLIC has to pop into our head. This means that it increases on the credit side of the business's accounts. So to give you a better visual understanding of what it actually looks like, we have the two affected accounts. This is bank and the loan. So as you can see, loan falls under the CLIC concept, and it's increasing on the credit side of the business. This is how the CLIC concept helps us to understand where to put the actual accounts. So we know that any account that falls under the CLIC concept, for example, our liability, which was the loan, it goes under the credit side of the business's account.